You've seen it before. People lined up outside a bank, holding their statements like they mean something. Cops at the door. No announcement, no news alert, no warning. Just a line and a locked door. That image, it has a name. They call it a bank run.
We were told we would get in. Stay open an extra hour.
What they don't tell you is they already decided who gets paid and who gets stuck in that line. And they put it in writing in documents you were never supposed to find. I mean, you watched the banks get bailed out with your tax money in 2008, and you were furious, rightfully so. But here's what they didn't tell you. They've since rewritten the rules. You see, after 2008, Congress passed a law that said no more taxpayer bailouts, never again, which sounds great until you realize what that actually means. You see, if taxpayers aren't covering the next banking disaster, who's taking the loss? Well, they decided who, and they wrote it down. They filed the paperwork. It is sitting on a government website right now. The person eating the loss in the next banking disaster, it might be you. Not because you made a bad bet, because your broker sold you something that is legally built to take that hit and called it a safe, steady income product. By the end of this video, you'll know if any of your savings are sitting in something a bank is allowed to just take and what you can do about it. All right, so here's what's going on. Every big bank in this country has to file what regulators call a living will. Think of it like a funeral plan. It's a document that says, if we go under, here's who gets paid first, who gets paid second, and who gets left waiting in line. Well, Wells Fargo, they filed one, and in it, along with the paperwork they file with the government for certain investments, they spell out exactly which of their products take the hit first. Here's the actual sentence from their filing. It is possible that our strategy could result in greater losses to holders of our debt securities, including the notes, than a different strategy would. Their words, filed with the government, on the public record. And this is the same bank that in December of 2022 paid $3.7 billion in penalties for what the government called a pattern of breaking the law across 16 million customer accounts. Wrongful home foreclosures, illegal car repossessions, bank accounts frozen for no reason. This is the institution that quietly designed which of their own products take the loss first. And not one word of that made it into the sales pitch at the branch, did it? Here is how they built this thing. There is a government rule put in place after 2008 that says big banks have to hold a certain amount of investments that can absorb losses before the bank itself goes down. And they gave this rule a name. They call it total loss absorbing capacity, TLAC, which is a lot like calling a shark attack an unplanned biological integration. They built themselves an airbag in case of a crash, except you're the one stuffed inside it. What it really means is this: if the bank loses money, certain investors lose their money first, so the bank can survive. And when Wells Fargo described these investments to global regulators, they said they should be, and I'm quoting, operationally straightforward to take losses on. Easy to hit, hard for you to fight. So about these investments that put you at risk, your broker might have sold you something called a structured note, or a yield note, or an income note, or a market-linked note. They go by different names. Here's what they actually are. It's a loan you're making to the bank. The bank takes your money, promises to pay you back with interest, and calls it an investment. Sounds fine until you understand what happens when the bank gets into trouble. When you put money in a regular checking or savings account, the government insures it up to $250,000. You've seen the FDI sticker. That protection is real. These notes, no sticker, no insurance. When you buy one, you are an IOU holder, not a protected depositor. You are in a completely different line, and a much longer line, a line that forms after the bank has already paid everyone with an actual claim. There's about $150 billion worth of these notes being sold right now in the United States. And a huge chunk of that is being pitched specifically to people in their 50s, 60s, and 70s. People who say, I'm scared of the stock market, but I still need some income. Well, here's the math they don't show you. Say you put $100,000 into one of these banknotes. If the bank gets into serious trouble, you are now in line behind people who have insured accounts, behind people who have government-backed bonds, behind a lot of people. Historically, people in your position get back well under half of what they put in, sometimes far less. In 2008, people who owned Lehman Brothers notes, just like this, saw their investments drop to pennies on the dollar because they were in the exact same spot in line that you might be sitting in right now. And look, this isn't ancient history. In October of 2024, the First National Bank of Lindsay in Oklahoma failed. A $107 million bank, gone. The FDIC said nearly $100 million in deposits exceeded the insurance limit. They initially gave those depositors back 50 cents on the dollar. 50 cents. And just 2 months ago, January 2026, Metropolitan Capital Bank and Trust in Chicago closed its doors. $260 million in assets. First bank failure of this year. These aren't big dramatic collapses on the evening news. They're quiet, a Friday afternoon press release. And the people who were in the wrong line found out the hard way. They take the risk. You take the loss. Every one of the biggest banks in America filed one of these funeral plans. Jamie Dimon at JPMorgan calls his balance sheet a fortress in his own documents. Charlie Scharf at Wells Fargo filed exactly what I just showed you, and then Jane Fraser at Citigroup. Her bank's document is the most plain-spoken of all. Here's what Citigroup put in their own public filing. Any value realized by holders of our unsecured long-term debt may not be sufficient to repay the amounts owed. May not be sufficient to repay. This is not my interpretation. That is Citigroup in a document they hand to people buying their investments, telling you they might just keep your money. Their words, not mine. Now, I know exactly what this sounds like right now. It sounds like something you'd read at 2 a.m. on a website you're not sure you should trust. So let me be very clear about something. This is not a secret plan cooked up in a back room. The problem is not that it's even hidden. The problem is that it is written in language that takes a law degree to find and another law degree to understand. And it is printed in the official government record. It's been public since 2017. And look, I'm just a guy who buys houses for a living. I don't have any insider knowledge, but I can read a press release like this. In June of 2024, the Federal Reserve and the FDIC reviewed the living wills from the biggest banks in America, and they stamped multiple ones with a warning. Not just JPMorgan. Several of the giant banks had holes in their plans. Holes that make regulators question whether the machinery actually works when things go wrong. The biggest, most powerful banks in the country have plans that the government's own regulators say might not hold up in a real crisis. And almost nobody is connecting that to the $150 billion sitting in those notes today. Your broker or your favorite financial advice guy on TV probably told you that the big banks are the safe ones. JPMorgan, Citibank, Bank of America, Wells Fargo, these places, they don't go under. Well, here's the problem with that advice. The bigger the bank, the more dangerous it actually is, for you specifically. You see, your local credit union doesn't have a 12-page funeral plan on file with the government. Your safe big bank does. This is FINRA. That is the government agency that oversees brokers and the people who sell investments. And here's what they say about these notes. You could lose all of your investment if the issuer of your note goes bankrupt. Investors who hold these notes are typically considered unsecured creditors and might recover little, if any, of their original investment. Straight from the government's own investor watchdog's mouth. And if you're over 60, you've already lived through enough of these once-in-a-lifetime financial disasters to know they are not once in a lifetime. .com crash, 2008, the pandemic, every time, regular people end up holding the bag. Here's what I'd be looking at if I were sitting at your kitchen table right now. First, pull out every investment and brokerage statement you have. Make 2 piles. Pile 1 is anything that says it's FDIC insured. Regular bank accounts, CDs, and money markets, up to $250,000 per institution. That pile's protected. Pile number 2, anything that isn't. Notes, income products, yield products, market-linked products. That is the pile you need to look hard at. One thing a lot of people don't know, there's a separate protection called SIPC that covers you if your brokerage goes out of business. But it does not cover you if the bank that issued your note fails. So if you hold a Citigroup note inside your Fidelity account, Fidelity is fine. Your Citi note is not. Second, ask yourself whether the extra interest is worth it. If you're holding a bank note instead of an insured CD because it pays a little more, how much more? 0.5%? 0.75%? Is that worth being in the wrong line if things go wrong? Third, think about what you own that nobody can just write off on paper. A house has your name on the deed. A rental property generates income they can't just come and take to save the bank. And physical gold held outside a bank account stored somewhere the banking system can't reach. These are the things that cannot be written down to recapitalize a holding company. And before you buy any gold though, visit hedgethefed.com and take the free dealer interrogation audit with you. It keeps everybody in the process honest. And fourth, if your checking, savings, and investments are all sitting at one giant bank, you're putting all your eggs in one basket. Spreading that around, it's just common sense, so do it. Listen, everything I've shown you, the Wells Fargo filings, the Citigroup language, the government's own warnings about multiple big bank plans, all of that is verifiable. I'll put all the links below in the description. What I'm about to say next, though, is my read on the pattern. I can't prove it, but here's what I think is happening. The fact that the government's own regulators have found holes in these bank plans and almost nobody is reporting it as a story tells me the people at risk have no idea they're at risk. The gap between what those documents say and what ordinary investors know, that is the real problem, not the banks failing. They've planned for that. The surprise is going to be the people who had no idea they were holding the wrong thing when the music stopped. So here's where you are. You got two choices. Option one, do nothing. Assume the bank has your best interest at heart. Assume the fine print doesn't apply to you. Assume it'll all work out because it always has. That's a choice, and a lot of people make it. Option two, you move the money. You pull the statements, you find the notes, you ask the question, and then you sit there wondering, okay, now what? Where does it go? Because if the answer is just put it in a different bank, you haven't actually solved anything. You've just changed your spot in a different line. That's the part you don't hear people talking about very much. So getting out, that's step one, but step one without step two, it's just anxiety with better paperwork. So what I did is I pulled out this video here for you to watch next, because it picks up exactly where this one stops. It's about where all of these people who figured out what we've been just talking about, it's about where they're actually moving this at-risk money. You see, we don't wait, we don't hope, we defend. God loves you, and so do I. See you soon.